Big news. Just a few days ago, Scott Bessent issued a warning that shook Wall Street. The US dollar is experiencing its deepest crisis since the 1970s. For half a century, the dollar was the foundation of global trade, the currency underpinning nearly all cross-border transactions. But now, in August 2025, that foundation is starting to crack. The numbers already speak for themselves. In July alone, global investors pulled $13.5 billion out of US equity funds and redirected that money abroad. Europe, Asia, and emerging markets are now attracting capital that used to flow steadily into the United States. And this is not just a reshuffling of portfolios, it is the largest outflow in 4 years. Investors are not acting on a whim. They are searching for safer havens and better returns, as they increasingly distrust the resilience of the American market. What's most revealing is the reasoning behind these decisions. The majority of institutional investors openly say US equities are overpriced. The numbers on the screens are inflated, disconnected from the real state of the economy, and they are far from alone in that view. A recent Bank of America survey showed that 7 out of 10 fund managers expect stagflation, the toxic mix of high inflation and slowing growth. Even more alarming, 9 out of 10 believe US stocks are trading well above fair value. That's why portfolios are being rebalanced. Managers are cutting exposure to the United States and shifting more aggressively into gold, emerging market securities, and international assets. They are preparing for a period when growth stalls, inflation erodes returns, and the dollar loses part of its appeal as a safe haven. Let's piece together the full picture. The latest Bank of America Fund Manager survey leaves little doubt. 91% of respondents said US stocks are overvalued, and 70% are convinced the country is heading straight into stagflation. This is not fringe opinion. Nearly 200 managers participated, controlling about $500 billion. When people commanding that scale of money speak almost in unison, it's a serious signal. At first glance, the stock market looks healthy, even near record highs. But that growth rests on just a handful of tech giants. Beyond those names, many sectors are weakening. For professionals, this looks like the final stage of the cycle. The glossy surface numbers hide a fragile foundation. Politics makes the outlook worse. Inflation was expected to cool, but in July, the core index climbed to 3.1%. At the same time, production and trade slowed, rising costs on one side, falling demand on the other. That is the textbook definition of stagflation, and tariffs only intensify the effect. Each time the US raises import duties, those costs ripple through supply chains. Producers pay more, and eventually families feel it in stores. This is where Trump's strategy becomes critical. Tariffs were introduced with the promise of protecting American workers, but in practice, they function as a hidden tax. Some of the new duties this year effectively added more than 80% to import prices. Then, the administration rolled some back, only to impose new ones weeks later. Such instability makes planning impossible for businesses. Instead of expanding and hiring, companies wait for clarity that still has not arrived. That stalls growth precisely when inflation is accelerating. For investors, the dilemma is straightforward. If companies raise prices to offset tariffs, consumers suffer. If they hold prices, profits shrink. Either way, the markets take the hit. On top of that, there's the risk that foreign buyers of US debt begin stepping back. That would push treasury yields higher and make stocks even less attractive. That's why managers are calling equities overvalued. They are not guessing. They are crunching numbers on earnings, costs, and growth, and the equations no longer add up. The outcome is clear. The economy is being squeezed from both sides. Growth is slowing while inflation refuses to ease. The market still shows impressive numbers, but beneath the surface, pressure is building. Now all eyes are on the Federal Reserve, stuck between fighting inflation and trying to avoid a market collapse. The Fed has been cornered with no easy exit. Inflation is climbing again. Prices in stores keep inching higher. Fuel remains expensive. Families are barely making ends meet. Cutting rates to give the economy breathing room would only fuel price growth further. But keeping rates high means pressuring businesses, making credit more expensive, and risking the burst of a fragile stock market bubble. Any decision carries heavy consequences. The labor market only deepens the dilemma. Recent reports show hiring is slowing, new jobs are scarce, and some industries are quietly trimming staff. Under normal circumstances, that would push the Fed toward cutting rates to stave off recession. But the problem is that inflation is not easing even as the labor market weakens. This rare combination, weak employment on one side and stubborn price growth on the other, leaves the Fed caught between conflicting signals, with the risk of being late no matter what it does. Investors are watching closely, and many do not like what they see. Hedge funds are pulling money out of equities, while gold and treasuries are becoming attractive again. Ordinary families, meanwhile, are increasingly worried about the safety of their savings. When markets are overheated and the central bank is boxed in, confidence can collapse very quickly. The Fed's indecision only adds fuel to the fire. Anxiety is growing that a single misstep could trigger a chain reaction across the economy. And if assets are already dangerously inflated, the real question becomes, what happens when this fragile balance finally breaks, when stocks are trading at inflated prices, and everyone knows it? The issue is not whether valuations will fall, but how exactly the fall will play out. If the correction is gradual, companies and investors might adapt, but history shows that at this level of overheating, downturns are rarely soft. More often, they arrive as sharp crashes that ripple across the entire system. Take today's market. The S&P 500 and Nasdaq are hovering near record highs. At first glance, that seems like a sign of a strong economy, but behind the glossy numbers lies a very different reality. Why are stock prices so elevated if professionals insist the market is overvalued? The answer lies in distortions created by Trump's tariff policy. When tariffs surged earlier this year, companies rushed to import goods before prices jumped further. That artificially boosted demand and created the illusion of booming activity. Later, when some tariffs were temporarily paused or adjusted, businesses scrambled once again to restructure supply chains, triggering another short-term spike in orders. These bursts pushed markets upward, but none reflected genuine growth. This was not business confidence. It was survival strategy, an effort to stay one step ahead of unpredictable rules. As soon as the pauses end and tariffs take full effect, the artificial demand will vanish. Along with it will disappear the illusion of strength that has been keeping the market afloat. The real danger lies in what follows. If the repricing unfolds gradually, the economy may still absorb the shock. But if the bubble bursts abruptly, trillions of paper wealth could vanish in just a few weeks. Pension funds would lose value, family savings would evaporate, and people would slash spending almost instantly. And consumer spending makes up around 70% of the US economy. Once households start tightening their belts, growth halts sharply and for a long time. Businesses, already squeezed by expensive imports, will not offset the decline. On the contrary, job cuts, investment freezes, and retreat from expansion would begin. The downturn feeds on itself. Market decline erodes confidence, and falling confidence further drags the economy down. All of this is happening against the backdrop of rising prices for food, rent, and energy. What now looks like strength is in reality the result of chaos. When the temporary stimuli disappear, the market will be left without a foundation. Meanwhile, as the US economy suffocates under tariffs, China is moving along a different trajectory and gaining momentum. In just 2025 alone, Chinese exports grew by 6.1%, and in July by another 7%, well above forecasts. And this at a time when global trade overall is slowing. Even more striking, China's trade surplus reached $683 billion, 32% higher than a year earlier. These are not just pretty numbers. They show that Chinese companies feel confident precisely where the dollar is losing dominance, and American exporters are ceding ground. This outcome is no accident. Beijing has spent years building a foundation through currency swaps and local currency trade deals across Asia, Africa, and Latin America. Today, when Brazil ships soybeans to China, settlements are increasingly in yuan. When Russia supplies oil or gas to India, payments are in yuan or rupees, not in dollars. Deal by deal, the global system is being rewired. And while the dollar weakens, global investors are already making their choice, quietly reducing exposure to the US, preparing for the storm. Investors do not wait for headlines. They are already leaving the market. One of the clearest examples is the Ontario Teachers' Pension Plan, one of the largest in Canada. In just a few months, it slashed its US dollar-denominated holdings by 56%. That means more than $50 billion were sold off. More than half of its entire portfolio in a single strategic move. And Ontario is far from alone. Across Europe and Asia, funds are trimming US exposure, alarmed by dollar weakness and the risk of negative real returns. The logic is simple. 10-year US Treasuries yield about 4% annually, but if inflation stays above 3% and the dollar drops another 10%, those securities turn from protection into guaranteed losses. What for decades was considered the safest investment now looks like a trap. The scale of such risk is colossal. Global investors hold nearly $80 trillion in US assets, stocks, bonds, treasuries. A 10% fall in the dollar instantly erases $8 trillion in value. And if panic sets in and selling accelerates, this will not just be another market downturn. It could trigger a wave of capital flight powerful enough to redraw the entire global financial map. What we see now may only be the first tremors. The real crash may still be building beneath the surface. And when it breaks, the impact will strike not only Wall Street, the consequences will spill across the entire world economy. So, if you want to stay ahead of these shifts, subscribe and turn on notifications. See you in the next episode.